So there are three ways of measuring GDP. We just talked about using value added to measure GDP, and that measures the amount of production, the value of production in the economy. We can also look at the income of the households in the economy. And to do that, we'll usually approach the income tax department or the income tax bureau. Most countries will collect income tax from their residents. So we ask the income tax department, what is the total amount of household income of all the households in the economy? And that calculates GDP using the income of the households. And lastly, we can look at the amount of spending in the economy. And spending in the economy is done by one of four groups. Firstly, you have households doing consumption spending. Then you have firms, company buying capital goods, and that's investment spending. Then you have government spending. And lastly, we can use goods and services, GDP, for international trade. That's spending by foreigners. And so international trade is another way of using our GDP. And no matter whether we're calculating using a production method or income method or expenditure method, they're all measuring the same thing. They're measuring the circular flow. So in theory, they should be the same number. Now, in practice, we always end up with slightly different numbers depending on the method used to calculate GDP, because of accounting errors or measurement errors, or people cheat on their taxes. So we always end up with slightly different numbers, but in theory, they're all measuring the same thing: the flow. That's the economy. Now, let's look at these four different methods of using up our GDP, of using the goods and services produced. First, we have consumption. That's by households. Whenever households buy things, we consider that consumption. Even if households buy the same things as firms, let's say a company goes out and buy a van, well, that's considered investment capital goods. But when a household buys a van, that's consumption. Now, it's consumption of a durable good because it lasts for several years, but it's still considered consumption. Other types of durable goods consumption would be like buying a washing machine might last 10 years, or buying furniture. But most of our spending is actually on non-durable goods or services. Non-durable goods are things that we use up almost immediately. Let's say food, you buy a food, you eat it, it's gone. Or toys might only last a few weeks. Or clothes might last 1 year or 2 years. And services is another big part of our consumption spending. Services are things that you buy, but you don't get a thing in exchange. You get a service. So like getting a haircut or taking a taxi ride. Or the largest part of our services consumption is actually consumption of housing services, rent. And more than rent, we also calculate imputed rent for the people who live in their own apartments, so that we calculate all of the housing services that's being consumed by the people in the economy. Now, so consumption of housing services is rent that is paid by the renter to their landlord, but we don't want to lose out the housing services that are being consumed by people who live in their own apartment or owner-occupied housing. So for them, we calculate how much rent would they get if they were to rent out their apartment. So that's what they're giving up. That's the opportunity cost of living in their own apartment. That's their cost of housing. And we consider that to be their payment for housing services, imputed rent or estimated rent. And we add that to the rent paid by renters and landlords to get the total amount of housing services that's being consumed in the economy. Now, if we don't do this, we leave our imputed rent, we'll be missing a big part of housing services, because owner-occupied housing might be about 50% of the consumption of housing services. And then if the owner occupancy rate in the country changes, let's say owner occupancy rate goes up, then if we don't calculate imputed rent, then the GDP would fall. That's wrong, right? So we have to calculate imputed rent. Now, imputed rent is the true economic cost of housing, not the amount you paid for the apartment, or not even your mortgage payments. I mean, people might think, oh, my mortgage payment is how much I'm paying for housing. I bought this apartment for 1 million, that's how much I'm paying for housing. But no, it's the rental you're giving up, the opportunity cost. That's your true economic cost for your housing. So that's what we put into housing services. Now, what's the amount you paid for the apartment? Why is that not the cost of your housing? Because when you buy an apartment or you buy a house, you're buying a capital good. You're making an investment. You're buying a capital good, so it's part of investment spending, not part of consumption spending. So investment spending, most of it is by firms buying capital goods. Usually we classify that as plant, property, and equipment. Plant is like your factory, property is real estate, equipment is machines, machinery you have in your factory. That's the classic categories of business fixed investment. And like I mentioned, residential investment, the buying by households of new homes and apartments, that's also part of investment. And there's another part of investment, which is actually not sold on the markets, but we still calculate that as inventory investment. Inventory investment is when a firm produces goods, but they don't sell them. Instead, they keep them in their warehouse, build up their inventory. We consider that to be the firm buying the goods for itself to build up the inventory. So that's inventory investment. So let's say I have a shoe factory. I produce 10,000 shoes this year. I only sell 8,000 shoes. The 2,000 I put in the warehouse, build up my inventory. That's inventory investment by me, by my firm. Now, if I build up my inventory, I have positive inventory investment. But when my inventory goes down, I can have negative inventory investment. So next year, my inventory is 2,000 shoes. I sell 1,500 shoes, and I only have 500 shoes left in inventory. That 1,500 shoes is negative inventory investment. I'm drawing down my inventory. So inventory investment can be positive or negative. Now, what about if a firm produces something and they don't sell it and they don't put it in the warehouse, instead they throw it away? We consider that just a cost of production. That's not calculated as GDP. You can consider like a firm is making a cloth, and then it makes so many square yards of cloth. But in order to package it and sell it, they have to cut it, and then some cloth left over, they just throw it away. How much cloth do they produce? Only the one that they sell. The one that they throw away, that's not counted. All right, so residential investment is spending by households on real estate, apartments, houses, but it should be newly built real estate. If it was built in the past, then the buying of, let's say, a 10-year-old house, that's, you're buying a second-hand good, and that doesn't count as part of GDP, as part of new investment. So let's say the house was built in 1990, and then I bought it in 2010. When the house was built, that made the GDP go up in 1990. And in 2010, when I buy, the GDP is not changed by my buying of that 20-year-old house. Instead, the things associated with the selling of the house, lawyers' fees, agents' fees, those are part of GDP. But the house itself is already built, so that's considered secondhand goods. Now, what if a company, the developer that builds an apartment or house, doesn't sell it that year? Well, if let's say they build a house in 2020 and they offered it for sale in 2020, but no one bought it. And then in 2021, they sold it. How do we count that? Well, in the year 2020, they bought it. They finished building it. They offered it for sale. It's already available. It's already produced. So it should contribute to GDP in 2020. How do we do that? We consider that as inventory investment by the developer because they didn't sell it. They produced it, but they didn't sell it. So housing that's already built in 2020, offered for sale as inventory investment. And then when they sell it in 2021, that's residential investment by the household, but it's negative inventory investment by the developer. So it cancels out. So 2021 2021 GDP on net doesn't change. Now, what if the developer offers it for, let's say, 1 million in 2020, and in 2021 they only sold it, they only managed to sell it for 800,000. Well, what we do is we go back and we change the number. And originally they had 1 million inventory investment. We say, oh, that was wrong. We adjust it and make it 800,000 on the inventory investment in 2020. And this is a normal occurrence. GDP numbers are often adjusted after the fact. So you always go back to previous year numbers and adjust. Oh, investment was this much before, GDP was actually this much before. It was inaccurate. We adjust the numbers. So residential investment and imputed rent seem to be measuring the same thing, the same apartment twice. And many people are troubled by this. I think, is it double counting? We're counting when you buy an apartment, that counts as investment, but when you live in it, that counts as consumption. Isn't that double counting? It's not. It's not. This is actually normal. Whenever you buy a capital good, it's going to count towards both investment in the year when you buy the capital good and consumption when you use that capital good in the production of other goods or services. So consider that I build a shoe factory. In the year I build a shoe factory, that's investment. But when I make shoes and sell it, that's consumption. Now, if I build a hotel, that's investment. And when I rent out the rooms, that's consumption. That's housing service for the people who rent my rooms. So similarly, if I buy a house this year, that's investment. And when I live in it in the future, that's consumption of housing services. It's the same idea going on. So investment is the buying of capital goods, mostly by businesses, but by households, and it's residential investment. But it's always the buying of some final good that's a capital good that counts as economic investment. In everyday life, whenever we talk about investment, actually we mean financial investment. Now, financial investment for an economist is not investment. For the purposes of this course, and whenever economists, macroeconomists talk about investment, it's always the buying of capital goods. Financial investment, the buying of financial assets. Let's say putting money in the bank or buying stocks or bonds. Actually, for a macroeconomist, that counts as savings. We'll talk more about this when we talk about the financial system. So when you buy a financial asset, in normal language, we call that investment. And that's financial investment. Financial investment for a macroeconomist is actually it's savings. So third use of GDP is government spending, government purchases. And whenever the government buys a final goods or service, that's government spending. And a lot of government spending is actually just providing services for the people, schooling, policemen, and all that. But also, there's buying by the government of goods as well, building bridges, building roads. That's infrastructure investment. Now, infrastructure investment, even though that infrastructure you can say is a capital good, it's a public capital good, we don't consider that investment. Investment is private capital goods. It's buying by firms of private capital goods. Public capital goods, government capital goods like bridges and roads, that counts as government spending. And all of the government spending on goods and services provide services to the people. That's all counts as government spending. Everything in the government budget counts as government spending, except for one type of spending. Spending where you're giving money to households or transfer payments. That doesn't count as government purchases. What do I mean by transfer payments, payments to households? That would be if the government, let's say, is giving money to the poor people, welfare payments, or in some countries, when you lose your job and you're unemployed, you get unemployment payments. These are transfer payments. They don't count as government spending. And similarly, if the government is giving money to households because of interest payment on government debt, so you've bought a government bond and the government pays interest on the bond, you receive payment from the bond. That money that you're being paid, even though it's government spending, you can say, it doesn't count as the macroeconomic government purchases. Instead, it counts as a funny thing, yeah, it counts as negative taxation. Now think of what taxation is. Taxation is when the government gets money from households. So when money flows from the households to the government, that's taxation. But this transfer payments is when money flows from the government to the households. So it's the same type of movement except backwards. So these transfer payments are considered negative taxation. So for macroeconomics, when we look at total amount of taxation in the economy, we will look at the tax collected minus the transfer payments to the households. So taxation always means taxes minus transfer payments to households. Okay, so that's government spending. And lastly, we have international trade as a use of GDP. So goods and services, some of it can be sent overseas. And that's exports. But then some goods and services flow back into our economy from overseas. That's imports. So we have to minus out to get the net flow of goods and services overseas. That's net exports, the value of exports minus the value of imports. That's the use of our GDP for international trade. Now, these goods that are flowing out, flowing in, they might be used for consumption or investment or government spending. It doesn't matter. But if we have positive net exports, it just means that the total amount of consumption, government spending, and investment in our economy is less than the total amount of production, because some of that production is being used overseas. Now, on the other hand, if we have a trade deficit, that is, net exports is negative, as imports is more than exports, then it's actually possible for consumption, investment, and government spending to be larger than the total amount of our production, because goods are flowing in from overseas. So these are our 4 ways of using production: consumption, investment, government spending, and net exports. So this is here. This is what we usually write down to try and express this idea. You'll see this equation quite often. Y is equal to C plus I plus G plus NX. And that's just saying what I just said, that our production can be used in 4 different ways. It can be used for consumption, it can be used for investment, it can be used for government spending, or it can be used for net exports, trade. And when we add up all of these 4 uses, that will be equal to the amount of production in our economy. So here's an example of y is equal to c plus I plus g plus nx. So we have in this economy, simple economy, only cars are being produced. We're producing 1 million cars, and they're worth 15,000 each. So we have 15 billion in production. Now, if the consumers are buying 700,000 cars, and we have consumption of this much, business investment of this much, government spending of this much, net exports of this much. But now, suppose that not all of the cars are sold. We produce 1 million cars, and only 975,000 cars are sold. And GDP doesn't seem to add up. Well, that extra 25,000 cars, remember, that's inventory investment. It's not sold. It's not thrown away. It's not thrown away, not sold, but not thrown away. So it goes into inventory. That's inventory investment. We add that to investment. So we say that investment in inventory is going to increase this investment by these 25,000 cars unsold. So this will increase our investment by that much, then it will add up. So in a sense, the inventory investment is a cheat. It's a way of making sure that Y is always equal to C plus I plus G plus NX, because anything that's not sold is absorbed by investment. So let's look at some questions now and see if you can answer it using these ideas I've just presented. So firstly, we have a restaurant, prepares 20 meals at $50 each, sells only 10 of them, but it's food, so they throw the rest away. So how much does GDP increase by this activity? Now, secondly, we have Sarah spends 1,800 on a new laptop to use in her business. So that's investment. But the laptop was built in Malaysia, not in China. It's built in Malaysia. So it was imported. So how does that affect our consumption investment, government spending, net exports? And thirdly, suppose Jane again buys a computer to use in a business again, but bought last year's model. So it was produced last year. So how do we calculate that for the GDP accounting, for the national accounts, we call it? And lastly, if General Motors, let's say this in the US, General Motors builds 500 million worth of cars, but the US consumers only buy 470 million. How does this affect US GDP accounting? Okay, think about this for a minute and we'll pause the video here and come back and give us your answer, okay?